Binance US sued over promoting, selling UST and LUNA. Plaintiffs allege the exchange was unlawfully selling unregistered securities and inaccurately described them as safe and fiat-backed. A class action lawsuit was filed today against Binance US, alleging that the cryptocurrency exchange misled consumers about the safety of Terra's stablecoin UST and native token LUNA. The suit also claims Binance violated federal law both by selling UST and LUNA, cryptocurrencies that the plaintiffs claim are securities that should have been registered with the SEC, and by operating as an unregistered securities exchange. Filed this morning in the U.S. District Court for the District of Northern California, the class action marks the first major attempt to utilize the American court system to rectify the damage caused by the spectacular collapse of UST and LUNA early last month, which wiped out some $40 billion in value. The plaintiff cites Binance advertisements that, in the months preceding UST's crash, touted the stablecoin as safe and fiat-backed, claims which the plaintiff's attorneys argue are demonstrably false. UST is an algorithmic stablecoin that, unlike other stablecoins backed by real-world assets, relied solely on an algorithmic relationship with Terra's native token, LUNA, for stability. As designed, a mechanism was created to always permit the exchange of one UST for one LUNA should UST falter from its peg to the value of the US dollar. This setup was meant to incentivize speculators to close any value gap between UST and the dollar. The mechanism worked until last month, when UST's sudden pegging brought LUNA down with it, collapsing both tokens' value and wiping out thousands of investors, including the as of yet undisclosed number of plaintiffs party to today's suit. According to the suit, Binance's failure to disclose UST and LUNA's risks to potential investors was not incidental, but intentional and fundamental to Binance's long-term strategy. Binance US's business model is premised on illegally enabling the sales of unregistered securities to as many US investors as possible, as often as possible, reads the complaint. Decrypt reached out Binance US for comment, but did not hear back by time of writing. The question of which cryptocurrencies the US government considers to be securities is still an open one. Last week, a bipartisan Senate bill proposed ending the SEC's oversight over the top 200 most valuable cryptocurrencies, and transferring that jurisdiction to the federal government's commodities watchdog, the Commodities Future Trading Commission, CFTC. That same bill would also prohibit the sale of stablecoins lacking a 100% cash reserve, like UST. Do Kwon shares LUNA burn address but warns lunatics against using it. Upon a persistent request from the Terra community, Kwon went against his initial plan and publicly shared a burn address for LUNA on Saturday. The recent Terra revival plan announced by Do Kwon, the co-founder and CEO of Terraform Labs, received mixed reactions as many questioned the effectiveness of a hard fork in reviving the fallen prices of Terra, LUNA, and Terra UST tokens. Instead, the part of the community recommended burning LUNA as the most plausible way to achieve a comeback. Kwon's proposal to preserve the Terra ecosystem involves hard forking the existing Terra blockchain without the algorithmic stablecoin and redistributing a new version of the LUNA tokens to investors based on a historical snapshot before the death spiral. However, several crypto entrepreneurs, including Changpeng CZ Zhao, opined that reducing supply should be done via burn, not fork at an old date, and abandon everyone who tried to rescue the coin. Upon a persistent request from the crypto community, Kwon went against his initial plan and publicly shared a burn address for LUNA on Saturday. Every LUNA token sent to this address will be burned immediately, effectively reducing the circulating supply of LUNA tokens. To clarify, as I've noted multiple times, I don't think sending tokens to this address to burn tokens is a good idea. Nothing happens except that you lose your tokens. 2 days after sharing the LUNA burn address, Kwon reiterated his point of view that reducing the circulating supply of LUNA tokens will have no impact on the market price, stating, "Nothing happens except that you lose your tokens." The Terra co-founder clarified that the burn address was shared with users only for information purposes and warned against using it. Happy to provide for information purposes, but want to clarify that you should not burn tokens unless you know what you are doing. I for one cannot understand. However, the revelation resulted in more confusion among investors. As Cointelegraph previously reported, LUNA's insane volatility serves as a lucrative opportunity for investors as many try to recoup their losses and others eye profitable trades. Quan has previously confirmed that Terra is no longer minting new Luna, which is one of the main reasons why investors believe a burning mechanism will improve Luna's price owing to scarcity. Amid an unclear roadmap for a resolution, investors are advised to refrain from making abrupt financial decisions as the master plan for Terra revival continues to be under public scrutiny. As a direct consequence of Terra's collapse, numerous projects sought to migrate to different blockchain ecosystems fighting for survival. Near Foundation, too, played its part by recently onboarding Tracer, a Web3 fitness and lifestyle app. Speaking to Cointelegraph, Near Foundation's Nikki Shalabi highlighted that projects like Tracer seek alignment with the ecosystem's core values and that projects must watch the interests of their community and users because, in the end, that's the most valuable thing you have. Shalabi further advised Terra projects to migrate only after considering the interests of their users and communities, stating that can actually define your success. Luna 2.0 v. Luna Classic debate, which one should you buy? It is roughly 1 month since Luna and UST crashed. There have been significant changes during that time, including a plan to keep Luna alive through a fork. The latter resulted in Luna 2.0 and Luna Classic. Many who suffered big losses from the Luna crash have distanced themselves from the project. However, there are those still looking for redemption and those looking to capitalize as Luna rises once again from the ashes. Distinguishing between Luna 2.0 and Luna Classic is important whichever side you are on. Understanding the difference between Luna 2.0 and Luna Classic. The Terra fork was aimed at keeping the network alive. The fork ensured that the original Luna, now called Luna Classic or LUNC. It is the Luna whose supply was inflated to a circulating supply of roughly 6.5 trillion coins due to excessive minting to try and maintain USD's peg. It also resulted in the creation of Luna 2.0, which has a much lower circulating supply of 210 million Luna. Luna 2.0 does not have a stablecoin backed by a mint and burn mechanism. Meanwhile, a proposal called Prop 29 was passed to limit the Anchor protocol's functionality as one of the efforts aimed at preventing future attacks. Luna 2.0 seems more popular on paper due to its low circulating supply and higher trading volumes. It clocked in $398 million in daily trading volumes in the last 24 hours, while LUNC had $193.7 million in daily trading volume. Luna 2.0 has so far tanked by more than 80% ever since it was launched. On the other hand, LUNC's crash in May presented an opportunity to buy at extremely low prices. The only downside was that there was little hope for recovery, especially with the massively inflated supply. However, LUNC's wild card is that its community recently passed a proposal called Prop 3568 which approved the burning of 653 billion LUNC. On-chain metrics also seem to be in favor of LUNC's bullish price action. For example, its supply held by whales dropped to 46.28% on the 7th of June, which is the lowest monthly level. However, it has since increased to 46.55%. This suggests that whales are accumulating to take advantage of the supply burn. LUNC's social volume and social dominance also registered a significant increase in activity this week. This is largely driven by increased activity behind the cryptocurrency such as proposals aimed at recovery. Luna 2.0 has also seen an increase in supply held by whales from 46.33% on the 7th of June to 46.55% at press time. LUNC will still have trillions in circulating supply even after the burn. Not much change is expected price-wise. Luna 2.0's eliminated mint and burn mechanism means it will likely not face another bank run. However, the biggest drawback for both cryptocurrencies is that it will be difficult to fully regain investor confidence. With that, we've come to the end of the video. Kindly subscribe and click on the bell icon for more interesting daily cryptocurrency predictions. If you find this video helpful and interesting, kindly consider liking and sharing our videos with your friend. If you have any questions or contribution, kindly drop them on the comment section below. Disclaimer. Please keep in mind that this isn't financial advice. We take no responsibility for any loss or damage caused by your actions or inactions as a result of watching any of our videos. You acknowledge that you use the information we provide at your own risk. Thank you for watching, and see you in the next one.